Hi folks, and welcome back to part 2 of our premium bond segment. What we're doing is we're using the same company we did in the first segment, Pfefferman Company, and what we're doing now is we finished 2011 in our part 1 video, and now we're moving on to 2012. What we're going to do here is we're going to go through the remaining entries for 2012 as well as 2013 and retire the bond at maturity. We're also going to produce a balance sheet so you can see at each intervening year end, that is April 30th, 2012 and April 30th, 2013, because we did 2011 in the previous segment. But we'll see for these two year ends what our balance sheet looks like. And we're going to use the table to help us get the journal entries as well as some of the balances in the balance sheet. So let's begin. Now, here we are, April 30th, 2012, and we have to now, because we're at a year-end, accrue some interest. So we know from our previous example that the interest payment is going to be $16,000 a period, right? So at this point in time, we know that April 30th, 2012 falls into this 6-month period that ends September 1st, 2012. And we can see here that that cash interest paid is the same as it was in every other period, which is $16,000. So we're going to accrue or set up to be paid at a later date an amount for interest, which is $16,000 times 2 months of 6. Because this relates to a payment for 6 months, we only want to accrue a payment for 2 months of 6. So we're going to credit our interest payable for $5,333. So what do we debit? Well, we know that over that 2 months of the 6-month period, okay, and again, we're in this period now, right? September 1st, 2012, because that's the period within which this April 30th, 2012 date falls. It falls somewhere in here, which means it's in the period that this ends, at this end date, right? So now what we're going to do is we're going to get our interest expense, which we know for the full 6 months, going from March the 1st, 2012 to September 1st, 2012, is $14,257. But that's for 6 months. We only want it for 2 months, so we're going to multiply it by 2 months and get $47.52. Now what we need to do is use the same logic and amortize our premium. Well, we can see our premium here is $17.43, but again, that's for 6 months. We only want it for 2 months of 6, so therefore we're going to debit or amortize our premium by $581. So now there's our journal entry. But we don't pay this interest yet. We'll be paying it on September 1st, 2012. But before we get to that date, let's do our balance sheet for April the 30th, because that is our year end. We can see that we have our interest payable from here, now mentioned over here, $53.33. And now we have to set up the long-term or non-current liability section of the balance sheet, which starts at with our bond at its principal value of $400,000. And then again, we have to add the premium. So how much of a premium are we going to add? Well, let's calculate it. We know that at the beginning of the 6-month period within which April 30th, 2012 fell, that unamortized premium was $73.46. Well, what we just did was amortize $581 of it. So we're going to take the $73.46, which is the unamortized premium at the beginning of the period within which the April 30th, 2012 date falls, and subtract from it the premium that we're amortizing to come up with $67.65. So therefore, our carrying value for our bond is going to be $406,765. And again, it kind of makes sense. It should fall somewhere in between here and here, right? Because our balance sheet date is somewhere in between, right where this arrow is. Our balance sheet is being prepared at a date which is actually closer to March 1st than it is to September 30th. So we do expect it to fall somewhere in between these two carrying values, but a little bit closer to this one, and we can see that it does. All right, now let's move on to what the interest would look like when it's paid. The entry, I mean, would look like when we pay the interest at the next interest payment date. Well, given that at April the 30th we accrued this interest payable, we're now going to pay it down. It's part of the $16,000 payment. But the other thing we need to do is we need to make sure that we include the rest of the interest expense and the rest of the premium on the bond, right? So what we could do, I guess I didn't do it here, but we could actually take this piece here, just copy it over into here just to make it clearer for you guys, right? And we can say that's times 4/6, and that will give us 9505, right? If you do the math. right? And we've got our premium, which we know here was 1743. And now we're going to amortize 4 over 6 of it, right? Because we want to get the rest of the 6-month period, which falls from where? It's falling from April the 30th, so it goes throughout all of May, June, July, and August. So these are the 4 months we're talking about here, right? And that's going to give you 1162. And I think we already know where this comes from, right? This comes right from your table. It's the interest that you're paying out. And this was from your accrual that you made on September the 30th. So this 4 months again represents interest expense and premium on bond that is going to be captured over the period that goes from May 2012 all the way to the end of August. So therefore by September 1st, we're recognizing these in the income statement. Okay, and any amortized premium is again included or is part of your interest expense, right? And you're going to credit your cash for $16,000. So we're good there. Now what we're going to do on March the 1st, we just do a regular entry because between September 1st, 2012 and March the 1st, 2013, April 30th doesn't fall in between there, so we don't have an intervening year end. So now for March 1st, we can go straight to our table, right? We can go straight to our table here and pick off our interest expense, our amortized premium, and the amount of cash we're paying out and just put it in our journal entry. All right? Now here we are. We're at April 30th, 2013. That is an intervening year end because it falls between March the 1st and the September 1st interest payments. So therefore we do have an intervening year end here. So we want to find the period within which this April 30th, 2013 period falls. And we know it's at the end of this 6-month period right in here because this 6-month period ends September 1st, 2013, but it begins March the 1st and April is right in between there. It's 2 months into the 6-month period. So we're now going to record interest expense of 2 months of this, 14,133, which is 4711. We're also going to record the premium on bonds, but this 1867 is for a whole 6 months. We only want it for 2 months of the period. So we're going to multiply it by 26 to get 622. And then again, we know we're accruing interest this date, so we're setting up our liability for interest that we'll pay in September 2013. But for now, we have to recognize an obligation to pay that interest at that later date. So we're going to set up 2 months of an interest liability here of 5333. So you'll notice now when we get to April 30th, 2013, again, we have an interest liability of $53.33, but how are we going to calculate the carrying value of our bond? Well, we know we start off in the long-term liability section with our bond at its principal or its face value, but how much premium are we going to add? Well, we know that we started this period off here with an unamortized premium of $37.99, of which we just amortized $622. So therefore, we're going to have unamortized premium of $31.77. So therefore, our carrying value of our bond will be $403,177. And again, it falls somewhere in between here, which is what we would expect, okay, because April 30th falls in between here, in between March the 1st and September the 1st. So this looks like we got a good number. So now when we get to September the 1st, 2013, what we're going to do is we're going to draw it down in our interest accrual from April 30th, 2013. And we're also going to take the rest, the other 4 months of the interest expense. So don't forget, we recorded interest expense here for 2 months at April 30th. Now we're going to pick up the other 4 months, and that's $94.22. And again, we're going to amortize the remaining premium of the bond. We picked up here 1867 times 2 of the 6 months. That was for March and April. But now we got to pick up the other 4 months, which is going to be May, June, July, and August, right? Because we're at September the 1st. So therefore, we're going to have $1,245 in amortized premium, and therefore we're going to credit cash for $16,000 because we do have to make an interest payment date on that date. So now here we are into 2014, and again, March the 1st of 2014 in between September 1st and March the 1st, April doesn't fall there. So now all we have to do is go straight to the table and we can pick off the amounts that we need for our entry. So we're going to debit our interest expense by 14,068. We're going to debit our premium by 1932, which is going to fully amortize the premium, and we're going to credit cash for 16,000, leaving our bond at its carrying value, which is now equal to its principal or face value of 400,000. And because the bond's matured, we discharge our obligation by reducing the bond liability, i.e. debiting it for 400,000 and paying out our investors that 400,000 that we owed them in cash. So this concludes part 2 of the premium bond, and in our next video we'll focus with the same data, changing the market rate of interest to create a discount, and have 2 little videos on the discount bond. Thanks for your attention.